So today we're going to be doing Compound with Carson episode 3. This is a series where I have a taxable brokerage account where I put $100 a week in, and I show you guys my buys, my portfolio performance, and the dividends, and much more. So I go over the news sometimes. Let's hop right in. So to begin, right now this is week 3, so I've put $300 in money in there, and it's up to $316. I made $10 a day alone off this, thanks to Nike stock, which is owned in this portfolio. Made a lot of those gains. And then Wynn Resorts had a pretty good week too. So this is my total portfolio right now. Right now my total profit on Nike is about 18.74%. My profit on Wynn Resorts is about $2.85. And Salesforce is about 3%, $2.28. So this is my entire portfolio right now. I have the most money in Adobe stock. And then it's Salesforce. Then I put $20 in Wynn, $50 in Nike, $50 in Google. So my smallest position is Wynn Resorts. But that's because Wynn Resorts has had a really good 2-week period. As you can see, I'm up 11%. So I really wasn't going to add much more to them. So the holding performance is up 20 in the last 7 days. As Nike's up 20%. Wynn Resorts is up 7%. Salesforce 3.3, Google 2.3, and Adobe 1.5. Honestly, this portfolio would have did a lot better if Adobe was only up 1.5%. My other portfolio that, if you want to follow me on X, Carson Talk Money, was up almost 7%, 7.99%, almost 8% actually, for this week, which is really good. I post updates on my X all the time. That's probably where it's the most relevant way to find me. So we're going to go over this. Wynn Resorts was up about 7% in the past 5 days. This is a hotel high-end chain that's in Vegas, Macau. They're building a property in the UAE next to Dubai. And they're about $10 billion market cap. They have a 1% dividend yield too. So I think the reason this one's up this week is, one, because of Carnival. Carnival gave really good numbers. So that means travel is doing pretty well, actually. A lot better than... If we were going into a recession, Carnival stock probably wouldn't be doing well. So it's a good not recession indicator. So that's the first reason why they're up. Second reason, we have JP Morgan Chase did a upgrade of them up to $109 per share, which is about 17.5% upside. That's the second reason. And the third reason is just insiders are buying the crap out of this one right now. We have a mini banks buying them, increased stake. This one increased by 120%. This one about almost $2 million worth. Just big buys out there. This was $139 million worth. So just huge stakes in the company. So, but I'm not going to give you only the good. So this report came out that the Vegas has reported 4 months of consecutive decline in tourism, most likely due to Canada and Mexico. So a lot of Canadians and Mexicans aren't going to come to Vegas. They would prefer to travel to a Canadian going to Mexico or a Mexican going to Canada because of the Trump tariffs. They're kind of boycotting America right now. So not great for Vegas. But in my opinion, the people that are going to Mexico or coming to Wynn Resorts are like the top 1% of income earners, top 10% of income earners. So the fact that people from Canada and Mexico, like majority of Mexicans, aren't going to be able to afford the high-end resorts. A lot of Canadians will, so they're going to lose a little bit of business from them. But like this is overall, Vegas numbers have declined. That doesn't mean Wynn Resorts. Wynn Resorts booking numbers, they're looking great. They're still very full, and they're still doing A-okay. So I'm not going to sell anymore right now. I might not buy anymore next week, just because I think other buys are probably going to be out there, but I think there's still a hold. I'm not really fully concerned about this. So next up is Nike. This went up 21%. And honestly, the numbers were not great. They beat by 2 cents. Revenue beat by $380 million, which is pretty decent, but still over a 12% decline. If you look at any of their revenues, down in every single region they're in. China was down. America was down. Many regions like Canada was down too. Many regions of theirs was down. But they surged 20%, 15% in one day. The reason for that is basically the Nike CEO came out and said, this is the bottom. This is the bottom for Nike. It's only up from here. They basically, yep, you see here, they gave reassurance that this is the bottom. That was basically it. And because of that, this is the bunch of ratings got upgraded. We got Bank of America, gave it a buy rating. Truist raised the price target from 73 to 85. And then Citigroup went from 57 to 68. The JP Morgan, 56 to 64. All upgrades. So the number one thing I saw in the earnings report that was, I think, probably a net positive was they're shifting production away from China. This will be seen as a positive by Trump. Trump wants to really get out of China. They're probably not going to be shifting production to America because labor's way too high here, but I could see them shifting production to Vietnam or India. So they're trying to get from 16% to about 8 to 9%, and they're also doing surgical pricing, so they're going to raise prices to offset the tariff losses. So these are projecting $1 billion in tariff losses. Because if you say this, the last 5 years Nike's been hated, but the 5 years before that they were loved. Absolutely loved. Nike was trading at like a 30 PE. Great company. Nike is a great growing dividend. They do a lot of share buybacks, and they're at a ridiculous evaluation. They're doing like $3 to $4 billion in share buybacks, and their market cap's less than $100 billion. They're buying close to 4 to 5% of their stock back every year, which is pretty good. And plus the dividends, it's really nice. So this is what I bought this week. I bought Salesforce, $25 of that. I bought $50 of Google, and I bought $25 of Adobe. So the reasons, I bought Adobe because this is just a strong business, subscription-based model. They have more cash than debt. They have a crap ton of free cash flow, and then they do a crap ton of share buybacks. So pretty simple with this one. They have Photoshop, a bunch of different subscriptions that make our life easier, and they're at a 19 forward PE. So I just think they're a pretty good value play. They have a really good CEO, and I think this one's going to perform very, very well in the future. Problem is they're getting held down by AI, but I think they're the leader in AI in this space. They're investing a crap ton of money, and even if there's an AI startup that takes some of their market share, they can just buy them. They have billions of dollars in free cash flow. So I would not be surprised if they can drop $1 billion or $250 million to buy a startup. So they're in a really well position for that. Then I bought $50 of Google. This one I actually did a full video on not too long ago. I'll probably drop the link here. And this one is just Google. They own Waymo, Google Cloud, and much, much, much more. So this one's a pretty good value play. So I have Google Search at net income of $120 billion. I have this at a 12 priced earnings, evaluation's $1.44 trillion. YouTube, they do $11.5 billion of net income, priced earnings of 35, which is pretty fair. Netflix is at a 45, so they do $402 billion. Google AdMob does $9 billion in net income, 20 priced earnings, $180 billion evaluation. Google Play, $18.8 billion in net income, 20 priced earnings, $367 billion. Google Cloud does $5 billion in net income, 40 priced earnings, which is a $200 billion valuation. And then I have Waymo at a $46 billion valuation. That the total valuation, $2.635 trillion, is what I came to the conclusion of. So that's why they're about 19% undervalued when I made this chart. They're up a little bit since then, but nothing too serious. I'm most bullish about Waymo, and I think Google Search at a 12 price to earnings is very, very fair. We got companies like Meta at a 40. So I think it's very fair for that to be at a 12, even with the AI struggles. Even if their net income declines, I think a 12 price to earnings is so fair. So, and also they're the most profitable company. And they just bought Wiz, which is going to strengthen their Google Cloud business. They're at number 3 right now. I could see them moving up. They have tough competitors with Microsoft and Amazon, but I think there's a way they can move up. So my last one is Salesforce. This is another company with just great free cash flow. They have a great cash position compared to debt. They do a lot of share buybacks. They have a growing dividend. And they're in a very niche spot with over 150,000 companies they work with. And I think they're in a well-positioned to do very, very great in the long term. They're also at a pretty fair valuation, about 27, 28 PE. So, and this is my dividend update. I make about $2.31 in dividends right now. I don't own any full shares of companies. We're still very, very small. We're starting out. It's only week 3. It's going to go on for a long, long time. So we're going to watch this baby compound. And let me know what stocks I should buy next week. So that's going to be it for this one. Thanks for watching.